Welcome to the wealth gap. Here's a mechanism that transfers wealth upward. The millionaires pay most taxes myth, percentage versus total explained. If you analyze tax contributions through the lens of wealth distribution, you'll find a significant discrepancy that undercuts the common belief that millionaires are disproportionately shouldering the tax burden. The narrative often goes that the wealthy pay the majority of taxes. However, the reality is far more nuanced. According to the IRS data for 2022, the top 1% of earners, those making over approximately $500,000, contributed 40% of federal income tax revenues. However, this statistic can be misleading without understanding the context. While they pay a substantial percentage, it's essential to consider the absolute value relative to their wealth. The total adjusted gross income for the top 1% was about $2 trillion in 2022, which translates into around $800 billion in tax contributions. Conversely, the bottom 50% of earners, with a combined income of $1 to $25 trillion, paid only about 3% of the total taxes, around $37 billion. Here's what this means for your wealth. Millionaires not only navigate a complex tax code, but also benefit from various tax provisions that significantly alter their effective tax rates. For example, while the top marginal income tax rate stands at 37%, many wealthy individuals have their income coming from capital gains, taxed at only 20%. This is a stark difference. The mechanism behind this disparity lies in the tax code itself. Provisions such as the step-up in basis, outlined in Section 10 and 14 of the Internal Revenue Code, means that inherited assets are not taxed on unrealized gains. This mechanism essentially resets the cost basis for heirs, allowing wealth to be passed down with negligible tax implications. If you look at this through the lens of the long-term debt cycle, it becomes clear that such legal structures promote wealth accumulation in ways that traditional income tax frameworks do not. The result is a widening wealth gap, not only in terms of income, but also in asset ownership and generational wealth. In 2022, U.S. households in the bottom 50% held just 2% of total wealth, while the top 1% held 32%. This transfer of wealth upward is not merely the outcome of investment savvy or market performance. It's systematically constructed by tax laws and loopholes that favor the wealthy. The thing nobody tells you about this mechanism: tax loopholes are often framed as ways for wealthy individuals to optimize tax efficiency, but in reality, they create a structural bias that exacerbates wealth inequality. Consider the carried interest loophole. This provision allows hedge fund managers to pay taxes at the lower capital gains rate rather than the higher ordinary income rate, which can represent a savings of billions annually for the wealthiest. In estimates from 2021, the carried interest loophole alone could be costing federal coffers around $20–30 billion in lost revenue each year. These laws disproportionately benefit those with the resources to utilize them, furthering the divide. Conversely, for everyday taxpayers, the burden is often managed through wage income, which remains taxed at ordinary rates. For the middle class, typical income tax brackets range from 12% to 24%, with nowhere near the same level of discretion or tax advantage found in the upper echelons. This structural inequality cannot be understood without recognizing how policy decisions condone such practices, often benefiting lobbyist influences and the wealthy. Those policies, like the tax cuts enacted in 2017 that reduced rates primarily for corporations and high-income earners, exemplify how political decisions translate into wealth consolidation. If you remember nothing else from this video, the perception that millionaires carry the tax burden is rooted in incomplete data. The actual mechanisms of tax laws illustrate a system designed to perpetuate wealth, not alleviate disparity. This systemic inequality manifests in education, healthcare access, and ultimately personal financial health, setting the stage for generational poverty. The stakes are high, and being aware of these mechanisms is crucial for the average taxpayer seeking to understand where their financial realities intersect with policy frameworks. This is where most people misunderstand. Wealth accumulation and transfer are often more about legal frameworks than they are about income generation. Understanding this dynamic is key to making informed decisions about personal finance and potentially influencing policy change in the future. As we watch this situation unfold, one has to ask, how does the gap between perception and reality influence your financial decisions? That wraps up the wealth gap. One small ask: if this was useful, hit follow. See you next time.